Hello, I'm Alex Davies, the founder of Wealth Club, and today I'm with Bill Nixon of Maven Capital Partners to talk about the Maven VCTs. Bill, tell me about Maven and also a bit about yourself.
Maven is an independent fund management business which has been in existence since 2009. We have a specialism in VCTs with around 200 million in management over 4 separate funds. I've been investing in smaller companies now for 30 years, 20 years as a VCT fund manager. So I'd like to think I've got significant experience in the sector. I'm also supported by a very large team throughout the regions. We have up to 50 investment professionals, 20 of whom are focused more or less solely on VCTs.
And tell me about the VCT. How many companies have you invested in? How big are they? What should investors expect from it?
I think, first of all, I'm a great believer in portfolio theory. I think we have 55 to 60 companies in each VCT, private companies, and I can see that growing to 80 plus. Portfolio theory, I think, is important when you're investing in younger companies where returns can be unpredictable and inevitably you get some businesses which underperform or fail. So I think that that is the optimum model to get that size of portfolio. We supplement that further by having a significant AIM concentration in each VCT, including the 2 which are making an offer this year.
And what's sort of the mixture of growth and older style investments?
It's about 40%, 40-40 in terms of older companies and newer companies. The balance is cash and AIM. We have to remain long in cash, clearly, because a number of companies require further funding rounds. But that gives a nice blend of solid income-producing older companies alongside younger companies, which have more dynamic growth characteristics.
And just touching on those growth companies, what sort of characteristics are you looking for? What type of companies are you on the search for?
Well, we've studiously avoided for some years anything that is consumer facing, even pre-COVID. We have a small consumer exposure, but very little. We're looking for companies with strong recurring revenues, which are not consumer dependent. And if you look at our portfolio, we're already invested in sectors such as software, where we have a significant presence, funeral services, training, cybersecurity, web archiving, and other sectors which are fairly defensive.
And tell me about some recent investments you've made.
2 recent investments I'd probably like to highlight. The first is Genicode, healthcare business, which uses genetic testing to deliver predictive analysis. And that determines an individual's predisposition to certain healthcare conditions, such as heart disease, cancer, and diabetes. And we believe that's the future of healthcare, where individuals are trying to determine their likelihood of getting certain illnesses rather than waiting until they're unwell. And also Quorum Cybersecurity. Cybersecurity is clearly a very interesting sector at the moment. And that's a business which has developed a specialty platform that helps companies with a number of cyber applications, including penetration testing, regulatory compliance, and forensic investigation.
And are there any recent exits that you've had that you would like to talk about?
2 exits, I think, worth commenting on. The first one is Attraction World. Attraction World is a business which supplies individuals with theme park tickets, mainly for the US. We sold that investment in February this year. The timing of that was clearly very fortuitous. We've also exited in June this year from Global Risk Partners, which is an older business, which was a buy and build in the specialty insurance sector. And we sold that to a US private equity firm called Searchlight Partners, and we delivered just under 2.6 times money for investors.
And how are some of the older companies doing in the portfolio?
I think generally well. Now that we've been able to observe the impact, of the pandemic over the last 6 months, I think 1 or 2 companies, clearly made some redundancies, cut some costs. We've had to conserve cash. But, looking at those businesses now, most have returned to close to normal. It's obviously important to have some of these older income generating companies in the portfolio. They offer more stable cash flows, and many of them also have loan notes, which contributes yield to each VCT, which helps support a programme of dividends.
And how has COVID affected you and all the portfolio companies? You touched on it briefly, but...
Yeah, I mean, I think initially we took some provisions, particularly in businesses which have consumer-facing exposure. Fortunately, we are not heavily exposed to those sectors. Beyond that, the impact has been surprisingly contained. I'm pleased that most companies are stable. We've availed ourselves of some of the government support programs, and most businesses are now trading close to normally.
And if you had also companies that have done particularly well as a result of COVID?
We have one that's done very well in the VCT portfolios, and that is Martel Instruments. And Martel it manufactures a specialty printing product, and that business has been flat out since COVID broke.
And what sort of challenges are you facing at the moment?
I mean, other than COVID, I think just making sure companies are well positioned for the recovery, making sure they have adequate cash. That's our main area of focus right now.
So last year when we spoke, it was, with most VCT managers, they were saying it's actually a lot of deals they were having to compete for and pay quite high valuations. What's changed now? Is it still hard to find deals, or has coronavirus meant that actually there's a lot more available?
There's definitely more companies coming into the market looking to raise money. There's no question. And that's for us quite good, because ordinarily certain companies that might not need to raise private equity or growth capital are now available. Pricing has not declined as much as I would have expected. I think it's very different. COVID is very different to 2008. In 2008 and 2009, there was a severe shortage of liquidity in the market. That's not the case now. There is still available capital. So pricing has been maintained surprisingly highly. I think where we have greater opportunities is, although we invest in London and the southeast, outside the capital, we do see better value, better deals, and less competition than in London. And that's a key strength of ours. We've completed investments this year in Edinburgh and Bristol and Reading and Newcastle, Manchester. And although there are clearly some very good companies in the southeast, they do tend to be heavily intermediated. So they always have advisors who will want the highest possible price. And often in an auction situation, we're not willing to compete because the price is too high.
Obviously, you've changed what you do, like all VCT investors. How risky is it now? So all your new investments, do you expect many failures?
Well, we've all had to pivot slightly in terms of investing in younger companies. We've recruited several PhDs to the team. We now have a lot of early stage investment experience. Inevitably, there are some companies that underperform, but I'm pleased to say that so far that's a fairly small percentage of our overall portfolio.
And Bill, if I want to invest in a VCT this year, or VCTs, why should I invest with you?
Well, I think the reason to invest with us is we have one of the largest teams in the industry. We have significant transactional reach outside of London. We're active in the regions where pricing is often better. We're a fully formed, or these two VCTs are fully formed hybrid VCTs. They invest in both private equity and AIM. So it gives investors access to two separate asset classes and one of the largest teams in the VCT industry.
Bill Nixon, Maven, thank you very much.
Thank you, Alex.